So basically, we had ministerial decision number 139 of 2023, which dealt with what are qualifying activities and excluded activities in the context of UAE free zone companies. The importance of this lies in the fact that if a free zone company conducts a qualifying activity, it is eligible for 0% corporate tax rate, whereas the excluded activities are subject to UAE corporate tax. So with the repealing of the ministerial decision number 139 of 2023, a new ministerial decision, which is number 265 of 2023, has been issued, which kind of adds on and clarifies as to what is the nature of activities which are going to get covered in each of the qualifying activity or in each of the excluded activities. This ministerial decision is applicable effective June 1 of 2023, which means that the content of this particular decision are effective as if they were issued from June 1 of 2023. So any decision which was given in this particular ministerial decision stands repealed. So we will move ahead and see as to what exactly is contained in ministerial decision number 265 of 2023. So the first thing that one needs to look at is what are the qualifying activities for a qualifying free zone company or free zone person that will be eligible for 0% corporate tax rate. As you are aware and you would have seen in some of our previous videos, a qualifying activity, unless and until it is done by a qualifying free zone person, does not qualify for a 0% corporate tax rate. Now, assuming the person who's conducting activity is a qualifying free zone person, what are the activities which are eligible for a 0% corporate tax rate? We are going to discuss each one of them individually in terms of what is contained there in some of the subsequent slides. For now, let's just see what these activities are. The first one is relating to the manufacturing of goods or materials. Now, what is manufacturing? What is goods, material? Of course, we're going to see that in detail because that is clarified there. The second is processing of goods or material. At a simpler level, if there is a goods that is in raw material shape, then it reaches phase 1, and then when phase 1 is worked upon, then it reaches a final product stage. The processing of goods from raw material to phase 1 or phase 1 to finished product is something which is covered here. Trading of qualifying commodities. So if you are doing trading, that is covered as a qualifying activity, provided what is being traded, the commodity that is being traded, is a qualifying commodity. Now, what is a qualifying commodity? Again, we'll come back to it a little later. Holding of shares and other securities as investment. So what this means is if you're holding shares and securities for trading purposes and not for investment purposes, trading is when you just buy and sell them over a short period of time. Investment is when the intention is to keep the shares and securities for a longer period of time. So when you're holding shares or other securities as investment, as a qualifying free zone person, that activity, the income from that activity will be considered as qualifying activity. The ownership, management, and operation of ships, reinsurance services, provided these are subject to the regulatory oversight of the UAE competent authority. Fund management services, provided again they are subject to the oversight of UAE competent authority, and we'll just see who exactly are UAE competent authority as we finish this list of activities. The wealth and management investment management services, again provided they are subject to the oversight of a UAE competent authority. Headquarter services which you provide to related parties. So important thing is these headquarter services should be provided to a related party. If you provide it to unrelated parties, then that's not covered because then you're doing it as a service more than something relating to the group. Treasury and financing services provided to related parties. Financing and leasing of aircraft. Distribution of goods or materials in or from a designated zone. What that means is that if there is a company A in a designated zone and it distributes goods to someone B who is also in the designated zone, that is covered here. Second is if A is situated in a designated free zone and they distribute goods to B, who is outside the free zone, then that is also something that may get covered here. Logistics services and activities which are ancillary to the carrying out of any of the Act first 1 to 13 activities. Now we discussed that the investment management services, the fund management, the wealth management services, they will be subject to being considered as a qualifying activity, provided they are subjected to the oversight of a UAE competent authority. Now, who exactly is a UAE competent authority? The Central Bank of UAE, the Dubai Financial Services Authority of the DIFC, the FSRA of the Abu Dhabi Global Market, and Securities and Commodity Authority will be considered as the competent authority. So the activities which we discussed earlier, if they are subject to regulatory oversight of either of these authorities, not necessarily that all of them, if either of the authority is actually having a regulatory oversight over the activities we discussed earlier, those activities will be considered as qualifying activity. Now let's look at each of these activities in detail. The first qualifying activity is the activity relating to manufacturing of goods or materials. Manufacturing of goods or materials includes the following: where there is a production of goods or material from another raw material or components, then that is something which is referred to as a qualifying activity. For example, if you use a raw material A and transform this raw material into another product B, so then basically there's a production of a goods B from raw material A. At the same time, there can be a situation where you have two components, C1 and C2. You use these two components and make a product, let's say D, which is a good. That is something which is going to be referring as production. The second is the case of an improvement from raw materials or components. Now, it might just be that there is no separate goods as such which is produced, but there's an improvement in one particular good. So let's say you have good A, which is of a given quality. When you improve the quality of A to another level, then that is also something which will qualify as a within the scope of manufacturing of goods or material. The third is assembly from raw materials or components. So sometimes what happens is that in order to produce a final good, for example, there are various components which are used. Let's say A, B, C, D. Each of these components may or may not be saleable individually. But when all of them are assembled together, they result in formation of a product which is different. So assembly from raw materials or components will also qualify as a manufacturing of goods or materials, and if done by a qualifying free zone person, will result in 0% benefit for a tax qualifying free zone person for income arising from such activity. The second is processing. Now, generally, the assumption is that when there is a manufacturing of good, the final product is different from the original product. But what can be done is that in certain cases, it may not necessarily be a case that there is a manufacturing of goods, rather there might be a processing of goods. What is included in processing? Processing basically includes the preparation, treatment, transformation, or conversion of one goods into another form. And the purpose of such preparation, treatment, transformation, or conversion should be that the output which is there, or the thing which is there, the goods or materials which are there after processing, are meant for either a commercial use or industrial use or sale. If these are meant for internal consumption, if it is a commercial use, then it's fine. But if it is for a personal use of the promoter or let's say an individual, then that is something which may not qualify here. If it's for sale, then also it is considered within the processing of goods or material. If it's for industrial use, it is again considered. But if it falls outside either of these three, then it may not amount to processing of goods. Now, there are certain qualifying commodities and recognized exchange markets. So first we need to understand what exactly is a qualifying commodity. A qualifying commodity can be either a metal, a mineral, energy, or agricultural commodity, which are traded on a recognized commodity exchange market in raw form. So what this means is that if any of these are traded on a recognized commodities exchange market, and what is a recognized commodities exchange market, we'll just see in a while, in raw form. The important thing is in raw form. It is not a finished form, in raw form. So if these are traded in a recognized exchange market in raw form, then they will be considered as a qualifying commodity. And what do you mean by a recognized exchange market? That's a commodities exchange market in the UAE, which is licensed and regulated by a competent authority, or a commodities exchange market which is established outside UAE but is of equal standing as this particular market, which is licensed and regulated by the competent authority. Now, what does trading of qualifying commodities include? Now, trading of qualifying commodities is one of the qualifying activities. What is included in that? First thing is physical trading activities of qualifying commodities. And what are qualifying commodities? That we just saw in the preceding slide, something like a metal, mineral, agricultural products, etc., etc. So if these commodities are being traded, right, that activity of trading of either of these metals, minerals, etc., will be included as a trading of qualifying commodities. So let's say if you have a free zone person, a qualifying free zone person, it purchases one of the purchases metal and then sells metal, right? So there's a physical trading activity of qualifying commodity by the free zone person. The income that it generates from such an activity will be considered as qualifying income. The second is any income derived from associated derivative trading used to hedge against the risk involved in these activities. So, there's normally a timing gap between that when you place an order and when you receive the goods. So let's say you purchase something for $50. By the time you received it, the price got reduced to $40. Now there is a loss of $10 which happened even before you received the product. To guard yourself against this risk, if you get into a derivative contract to hedge this risk, under which you get this $10 from the insurer, or let's say the commodity exchange from which you're doing, even this will be considered as trading of qualifying commodities, and therefore this income will be considered as qualifying income. And if the person is a qualifying free zone person, it will be eligible for 0% corporate tax rate. One of the activities which is considered as a qualifying activity is holding of shares and other securities for investment purposes. So the question that comes up is, what exactly is shares? What is included in other securities? And what do you mean by held for investment purposes? So under this clause, there are two things which are considered. One is the ownership of shares or other equitable interest. And this could be in a juridical person or otherwise, provided it is in the nature of an equitable interest. We'll look at what this constitutes in the next slide. The second type of instrument could be negotiable or non-negotiable financial instruments. And these are considered to be held for investment purposes if the shares and other securities are held for uninterrupted 12 months or more, and then only these will be deemed to be for investment purposes. So let's say if you acquire something on 1st of January, if you dispose it of, let's say on 1st of February, let's say this is 2024. If you dispose it on 1st of February 2025, that means you've held it for a period of more than 12 months. Against this, if you sell it, let's say on 1st of December 2024, then the period of holding is less than 12 months, and therefore these shares and investments or other securities will not be considered to be held uninterrupted, and therefore will not be considered as a, or therefore the income from these instruments will not be considered as income from shares or securities held for investment purposes. Let's move on to the next slide. And the question is, what does holding of share include? So basically, when we say you should be holding shares for investment purposes, what that means is you are the owner of shares in any class in share capital of another legal person. So let's say if I is an individual and ACO is a juridical person, if I is owning shares of any class in the share capital of ACO, or let's say there's a company XCO that owns shares in ACO, that is going to be considered as holding shares. Now, whether for investment purposes or not will depend on the period of holding. Whether the exemption is available or not will depend on whether the income is, once the income is qualifying income, is it earned by a qualifying free zone person. In addition to shares, you can also own other equitable interest in another person. The condition is that in these cases, the person who is holding the shares or the owner should have right to receive profits of the company. And in case this company is liquidated, then he should have a right to receive the liquidation proceeds. If these rights are not available, then basically it cannot be said that you are owning shares or equitable interest in other company, and therefore it will not meet the criteria of being a qualifying income. The second thing is a negotiable or a non-negotiable financial instrument, right? So what is included in negotiable or non-negotiable financial instrument? It includes certain derivative instruments, financial commodities, or other investment instrument. However, either of these which a person is holding should meet the following conditions. That is, they should be traded in the public or a private market, right? Or they not actually, or they should be convertible or exchangeable into a security, or they confer a right to purchase a security. So when we talk about a convertible exchangeable security, so let's say you own an instrument X, but the terms of ownership of X gives you the right to convert X into security, right? Or it gives you a right that you can give up this and buy a security. In either of these cases, such an instrument will be considered to be a financial instrument and will therefore be considered as a instrument which can meet the requirement of a qualifying income. However, if you hold financial instrument or investment instruments which are issued to you pursuant to the securitization of the receivable, then that is something which will not be considered as a negotiable or non-negotiable financial instrument.